Okay, I'll just make this video less than 3 minutes short. I don't want to waste much of the time, so let's just go straight to the point. So, criterias, what I'll be explaining is how I trade the Friday's daily range. I don't actually trade on Friday every time, but sometimes I trade on Friday once I see these criterias in the market. So, the first thing I want to see is I want to see a large range daily candles form within the week relative to the trend direction. That is from Monday to Thursday. I want to see Monday, Tuesday, or Wednesday go bullish. If I'm looking to to sell on Friday, I want to see Monday, Tuesday, or Wednesday go bullish. Or possibly I want to see from Monday to Thursday go bullish heavily. Then if I'm looking to buy on Friday, I want to see Monday to Thursday go bearish. Then 2, price approach a resistance level. Price approach a resistance level, that is another criteria. And the last one is price approached a psychological price level. I will explain this. So let's go to the chart. Uh, you can see explaining with the gold first. I want to explain with the gold and the equities. So looking at the gold chart this past week, you can see this is the weekly range. This candle here, let me put my crosshair. This candle here is the 17th of March 2025. So this is Monday, this is Tuesday, this is Wednesday, this is Thursday, and this is Friday. So you can see our first criteria was met here. You can see large range candles forming from Monday to Thursday. You can see it forms a weekly range. Monday forms the low. We have Thursday forming the high. So we can see large range candles forming here. Then after that, what we want to expect is we want to see Friday what? Go lower. Then also the gold has passed the psychological level of 3,000 because majority of traders have been talking about this level ever since. So as soon as gold gets there, it's expected and reasonable to see some profit taking or some mean reversion moves for the price to get to that level, or from mean reversion moves opposite the overall bias of the gold. So if the gold has been going bullish, we are anticipating a mean reversion move that would go to the downside. If it was going bearish, we'll be expecting a mean reversion move that will be going to the upside. But in this case, we're expecting it to go to the downside. So first, if you look at this week, you can see Monday, Tuesday, Wednesday went bearish. So what we are doing here, what we have to think here now is expect Friday to go bearish. So now let's go to the execution criteria, because we can't just expect Friday, we just go into the chart and we start selling. It doesn't work like that. So here I'll teach you about the breaker. Then the breaker block taught by Michael J. Hollis in ICT is a standalone pattern that goes like this: a bearish breaker and a bullish breaker. I will be explaining here with the bearish breaker. So the first thing we want to see is what? I want to see what market will trade up. Let me join this. I want to see what a sharp run to the upside in the market. Then after a sharp run, we want to see what a drop down below the low or close to it. It can be below it or close to it, it doesn't matter. want to see it what market what trade below it. The reason why I said close to it because of the market usually what draws to what areas where what prices are pegged in form of equal highs and equal lows. So if it's close to it, doesn't matter because some brokers with latency usually have issues. So you can see some broker A crossing. Let me just use this as okay. You can see some broker A crossing this price level, while you see some broker B just on top of it, or just yeah, just on top of it like this. So it happens. That's why I'm just telling you that if it's close to it, it's still okay for this strategy I'm sharing with you or risk event. So back to what I was explaining. So you want to see a run price run higher, you want to see another price run lower, then you want to see a retracement. You want to see a return into this price run lower, but you don't want to see what this return into the range. You don't want to see it go above this high. This is this price here. You don't want to see it close above this high here. So as soon as this market fails to close above this high and it starts dropping, you want to look for your sell and you want to target this level. So this is the breaker. Let me remove this. So this pattern here is the breaker, which is what you see here. Sharp run up, then price drops. It didn't take it here, but it did here. It went below this low here. It went below it here. Let me show you. You can see it. Let me draw this. It went below it here. So the breaker has formed. So as soon as price what let me okay. So this high to this low is a price range. It's a price range. So this high to this low is a price range. So our criteria, we've seen a large daily candles forming. Number one, that's number one. And also we've just passed what a psychological level of 3,000 in the code. So it makes sense to see some mean reversion what to the downside. Then another thing is what we are getting closer to the end of the month, and the last week of the trading month is what is month end flow. So what market makers usually do is what they do is what they usually what they edge towards that risk of month end flows. They usually edge towards that the last week of the trading month. So it makes sense to see a pullback into the what that goes what against the overall bias. So another thing to know is that this sharp run down is another thing to tell you that is what is a mean reversion, meaning what they are what profit taking. Some other traders in their strategy they call it what new what buyers want to come into the market. But I've not really what I don't really rely on that, because if you rely on new buyers coming to the market, you're telling me that you want to buy here, and which means this market can just retrace and continue dropping lower. But I don't want to tell you that. So what I'm sharing is what is a standalone setup, standalone strategy that you can use to trade on Fridays. That's what you should have in mind. So price drop here now. So this is the high, which is this high here. I showed you. Let me delete this. Which is this high I showed you. So price drop. So price retraced here. So as soon as price starts dropping, sometimes you don't have to wait. You don't have to wait. You can just sell from here. Sell from this level here. I will show you. I will go to the lower time frame where we use the fair value gap as an entry. You can just sell from this level here. because inside this range, what is fair value gap usually formed inside this price range. I will show it to you. So price here retrace here, then what just drops lower. And where did price get to? The psychological level of 3,000. It's not magic, it's just price, and it happens a lot of times. It happens almost every month. It happens. It might not happen in gold, but other assets it also happens. You just have to find it. What you want to look for is what market has been going up or going down. They want to look for this pattern towards the end of the month, either the third week of the month. It can even be the second week, it doesn't matter. But that's what you want to look for. Then before you execute, you want to look for this breakout pattern. This is the bearish breaker. All you have for the bullish breaker, just invert this pattern like this. So down, then up, uh, trace. What we have here, this range is our fair value gap. Then boom. You can see all you have to just invert it. So now let's go to a lower time frame. Let me show you a fair value gap that I was talking about. And I'll show you where to anchor your stop loss. 15 minutes. Yeah, let me zoom out. Okay. So this is 30 minutes. So where's the fair value gap here? This is it. Fair value gap is simply what a price or a candlestick or a price run whereby there is no reward, another candle that is formed inside the range. That is what is a sharp run in price. A sharp run in price, just like this. This is a fair value gap. This right here is also a fair value gap as well. This also a fair value gap as well. So it's a sharp run in price at what? That's what. Let's say if the fair value gap set to the downside now, it's a sharp run in price to the downside that gives no room for buyers to come in. Same what we are seeing here. There's no room for buyers to come in. So it was a one way. So what market makers, what they do is what they seek value, they seek fair value, which is of this price. Because the market usually it has to move it has to move efficiently, it has to deliver efficiently. So what they do is what they seek that fair value and they offer it to the marketplace. Why? Because the market has to be balanced. If you study the auction theory, that's what it is. The market has to be balanced. It can't be just one way side of the market. It just can't be like that. So it has to be balanced. So what they do is what they seek value, they seek fair value, and they will offer it down to the psychological level. So you can see how it makes sense. It's not magic. That's how it is. Even with the way price is consolidating here, it's trying to tell you that what they are doing, they are mitigating their longs. So what they do is mitigating their loss in the sense that what they sold, they are buying it back. Why? Because they want to seek fair value. And they simply offered it lower. So this is what ICT called the thank God it's Friday setup. Mind you, this breakout it forms on all time frame. You can see it in the daily, you can see it in the 30 minutes, 1 hour, even in the 15 minutes as well. Or in the 1 minute as well for those scalpers. You can see it there. You just have to look for it. So you have to navigate the time frame from the 4 hour to the 1 minute. So as you can see in the 4 hour, you can see how when I zoom out and you can see how it makes sense. So where the price get to our psychological level. And also let me so after getting the pattern, you look for the fair value gap. Also there's another breaker here, so if you look very well. Let me see how price what round through this high one, also these levels too as well. These are swing highs. I'm just using this one just in case for you. Can see how it round through this high one, two, then it broke down, which is what I was explaining. It broke down here, then retraced. So this is a breaker block. This is a breaker block. This is kind of open price. So this is a breaker block. You can see the sharp run here, just like what we saw in the 4 hour. The sharp one here, then it broke down here, retraced, then it dropped. It's the same we're seeing in this 30 minutes. Sharp run, then drop down, then retrace, seeking fair value. Then what? It run to the what? Sell side, reaching that psychological level of 3,000. So that is it. Then if you want to sell, you sell here in this fair value. As soon as this price get to this fair value gap here, the top of the low of the fair value gap here, as soon as it gets there, you sell. Then you put your stop loss here. Let me stop loss. You put it here. This swing high, you put it there. Then this is where you enter. Entry. Entry level. That's where you enter. Okay. That's where you enter. That's entry level. So you just enter, put your stop loss. Then what you want to aim for? 1:2. 1:2 in terms of your stop loss. You don't want to aim more than that. Then if it's close to the previous daily low, you can also aim for that as well as a low hanging fruit. So 1:2, 1, that's 1, and that's 2. That's what you want to aim for. Just 1:2 in regards to your stop loss and your entry level in the fair value gap. So stop loss, so price retrace, you enter there. You can even use a sell limit order. So price retrace, enter there, 1, then 2. Then as soon as you get to these 2, if you think maybe price can still go down, you want to maybe hold over the weekend, then what you do is what? If the price crosses this level now, 1:2, if you reach $100, you'll be about $250. So you can just close that $200, which is the 1:2. Then you move your stop loss to break even. Break even in the sense that you put it below your entry level because of the spread, because you have to pay spread as well. So you put it below your entry level. Then what? You leave the rest to run. So in case price goes against you, it comes to what? Your break even, and you not lose anything. You still gain your 1:2 $100. So that is it. So now let's go for the equities. Look at this. So this is what the 28th of what? 28th of February. 28th of February. So you can see it's Friday. 28th of February is on Friday. So you can see Thursday, Wednesday did not go down, but Monday and Tuesday, of course, it did. So what you want to see is Monday to Thursday. I want to see what form what large range candles to the downside, which it did. So then Friday, let's go to the Friday now. Our first criteria, Monday to Thursday, went to the downside. Then second criteria, price approach what? A resistance level, which is here, which is this level here. So price approaches resistance level. You can see. So let me remove this. So price approach resistance level there. so that I won't be lost. Okay, let me go lower because of the break I want to show you. So price approached the resistance level there, which is also a good psychological level as well, because if you look at the market here, anytime this market gets to this level, it bounces. So this level is a good level to take some profit. And they are taking profit, is a good level to see some main reversion moves to the upside. So let's go to the 30 minutes. Should be visible on the 30 minutes. So in this case, we'll be looking for the bullish breaker. We're looking for the bullish breaker. So what did I explain about the bullish breaker? Sharp run to the downside, which is this candle here. Sharp run to the downside. Let me go to the 15 minutes. Okay. Yeah. So a sharp run to the downside, then broke higher, then a retrace, it retrace. After retracing, mind you, the fair value gap is on the lower time frame. You can also enter here, it doesn't matter. Let me just complete this. Retrace, then boom, price went to the upside. That's it. So mind you, the fair value gap, let me show you. You don't have to be perfect. One thing in trading, don't look for perfection. If not, you hurt yourself. So for the fair value gap is on the low, it's in the lower time frame, because if you look very well in this bullish candle here, price run, you can see this next bullish candle, it came down, then it went upside, which is trying to tell you that they were sellers here. Make sure they were selling here before this candle decided to close higher. So you can see there is no one single bullish candle here in this price action. So in order for us to identify the fair value gap, we have to refine to the lower time frame. It's called the top down analysis. Hope I've not 28, okay, still far. Let me go like this. 28. So I don't want this video to be long, but now it's long. Why? Because that's just it. Trying to press trading strategy into few minutes is very difficult for me. Very difficult. So if you look very well now here, the only fair value gap, we don't really have, okay, the only fair value gap here is this 5 minutes here. But common sense, technically, we know that this market is still in is still in premium. It's still in premium. So what we want to do is we want to be looking to buy in a discount. So if you go to the 1 minute, you see the fair value gap here, but that will be a long way to go. You see fair value gap here, because you can see there's a long candle here, this sell, and this is a 5 minutes. So definitely in the 1 minute, you see the fair value gap here. And aside of that, if you could not find it, you can see it formed for you here. This is the fair value gap, and there's also another breaker here as well. If you go to the 1 minute, there's also another breaker here for you. Look at this one. Price this sharp run to the downside. You just have to open your eyes and identify it. Sharp run to the downside, then run, then it retraces for you to that fair value gap. then you buy. Then when would you put your stop loss? You can put your stop loss here. So those that buy that will buy in this, you can also put your stop loss here. So whichever is you are good to go. Even for those that bought here as well, because newbies when they are trying to implement this strategy, they usually messed up trying to buy in this kind of like buying in a premium when they are looking to buy, because normally if you in a price range, if you divide it into two, the upper side above equilibrium is a premium, then below it is a discount. If you can see also here, even right where this fair value gap was formed, you can see it was formed the discount price level. So that's it. So you can see from the fair value gap. Another thing to notice, you can also wait for that fair value gap to form. If you are looking for the buy bullish fair value gap, which is this, so you are looking for it to form. If you don't see it to form, then you can just leave that setup, then don't take it. It doesn't matter. Even if you see the breaker there. But seeing that breaker and that fair value gap forming makes it very strong and very powerful. Meaning your confluences as aligned. Then combining with our criteria, seeing the daily candles Monday to Thursday going bearish heavily, just like that, then we expect Friday to what? Move to the upside. So you buy there. Let's assume you buy here now as a newbie, buy this level here. Then you put your stop loss here. Let's see, can you get two handles? Let's see. One, you could not get two. But even if you could not get two, one, two, even if you not get two, it will make sense for you, common sense as a trader, to close your trade before Monday. It will make sense to not have risks, especially for equities, to not have risks holding into the following week. Just like how we saw the Nvidia, how we saw the market just opened and just see a deep seek running the Nvidia to the downside, the equities Nasdaq just follow through and just went down. So it doesn't actually make sense to hold risks into the following week for equities. Doesn't actually make sense. Then also for gold as well, even other asset classes, it doesn't actually make sense for you to hold risks into the following week. Unless it's just partials or something you are willing to lose. But normally it does not actually make sense for you to do that, and it's not really advisable. So it managed, at least it gave you one. You incur George and yes, and some newbies when price get to this level, so many of them will close their trade here. But it's okay, they will learn. Just how it is. When I started implementing this strategy, it all happened to me. I executed here majority of the times. With time, I started bearing the drawdown. Then sometimes I close, then just like then with time I refine, then I start executing in this kind of favorable gap here. So at least it gave me one handle, which is fine. If you reach 2%, you get 2%. Then for those that bought here, and you can ask me question on this, I'll show you my contact. You can ask me question. If there's anything you're not clear with, you can ask me, I'll show it to you. How many did they get? Get one. Let me just put at the top here. Two. Three. They got 1:3 already. Looking at this high as first target, 1:3 already. Because before that high, it gave 1:2, so 1:3. So you close that partial. Tilt 1:2 then, maybe leave the rest to run. So just like that. Sorry. 4. I will say 4. 4 is reasonable. 4. So close your trades before the new week open, which actually makes sense. So for as a newbie, what I would advise you is, as you are starting with this strategy, what you want to aim for is 1:1. Don't go for that 1:2. 1:1 makes sense. Then with time, understanding technical analysis, then you can 1:2, 1:3. Then refine your entries just like that. It's step by step. You don't have to rush. It's gradual something. Then another bonus takeaway that you can add to this main revision strategy that I use on to trade on Friday is the CFTC data, the Commitment of Traders report. So for assets like this gold, for instance, asset that have, if the gold has, for instance, let's say gold is stretched long, you can see majority of that what stretched long what unwind on Friday. You can see it, and that way you can actually get a lot of pips. You can just see that run through to this level, but you don't really want to see gold close below the low of the range of the week, that is Monday low, or if it's Tuesday that formed the low of the week, you don't want to see it close below Tuesday. So but I want to see this range, sorry, this weekly range, I want to see it stay intact. Mm, okay, this weekly range, I want to see it stay intact. This is the low of the weekly range at 2982.3. This is the high at 3056. So you want to see it stay intact. So in this gold, you can, if you are applying adding CFTC data to it, if it's for those that are using financial source CFTC report, if it's close to the 80th percentile rank, if you want to get the CFTC report, you sign up for the financial source. That's very good. They offer very good these fundamental tools, the institutional tools, very good. So you apply for it. You should pay for it and get it. It's very useful. So what you see is, we see if the gold is above the or close to the 80th percentile, so many of that stress long, you see them unwind, meaning what, you see them on taking profit. So you see them selling back to the market, and that way you see Friday what going opposite the weekly range. Now another thing to consider if you are looking at equities is what is risk exposure. So what majority of the times what market makers do is going to the close of the week, they usually what they may revert. So many of that in this case, so many of that stress short positions, what they buy some of them back, what they unwind, what managing risks, because they are edgers. They are edgers. So that's what they usually do. They manage the risks. So that is all. And if you have any question, you can feel free to reach me. You can reach me here at Instagram or Twitter at MCZ official, then Telegram Trade Dictator 1, or my channel Trade Dictator, then my email tradedictator@gmail.com. You can also check out my YouTube at Trade Dictator, where I post some live trades as well. So that's it, and I hope you find this teaching insightful. Until next time, good luck and good trading. Please be safe.